Today's lecture is going to involve, again, Kimmel, 7th edition, financial accounting. We're talking today about Chapter 9, which is analyzing long-lived assets. Again, we'll go through the learning objectives in a few minutes from the PowerPoint presentation, but essentially it's learning what long-lived assets are, talking about depreciation, talking about intangible assets, talking about the disposal of long-term assets. We're calculating gains and losses. So let's pull up the PowerPoint presentation for this chapter. And you should be able to see the PowerPoint presentation. Again, this is reporting and analyzing long-lived assets. And here are the learning objectives for this chapter. We want to first explain the accounting for plant asset expenditures, which are long-lived assets, and we're going to talk about what those are in a few minutes. Apply depreciation methods to plant assets. Thirdly, explain how to account for the disposal, the sale of plant assets. We're going to talk about identifying basic issues related to reporting intangible assets, those assets that you cannot physically touch, and discuss how long-lived assets are reported and analyzed on our balance sheet, the effects on the income statement, and some ratios. Explain the accounting for plant asset expenditures. What are plant assets? They are resources that have physical substance, you can touch them, definite size and shape, are used in the operations of a business. They are not intended for sale to customers. Unlike inventory, inventory is the stuff that we buy and sell to our customers. These plant assets are used to help produce the product, to help produce income in our company, are expected to provide service to the company for a number of years, hence long-lived, and they decline in service potential over their useful lives. These things are referred to as property, plant and equipment, or fixed assets. Here's some example. Plant assets are critical to a company's success. So you can see a company like Wendy's, 73% of their total assets are involved in plant assets, mostly property, as you can imagine, versus a company like Microsoft, where their big assets are not plant assets. Valuation of plant assets. The key here is historical cost principle. Requires that companies record plant assets at their cost, what they paid for them. Costs consist of all expenditures necessary to acquire an asset and make it ready for its intended use. We'll see some examples of that. Measured by cash paid in a transaction or cash equivalent price paid. The cash equivalent price is the fair value of an asset given up or the fair value of an asset received, whichever is more clearly determinable. Revenue and capital expenditures. So revenue expenditure, cost incurred to acquire a plant asset that are expensed immediately, versus a capital expenditure, and these costs included in plant assets are expended over a number of years. Let's look at an example for cost of land. Include all necessary costs incurred in making land ready for its intended use. Increase the land account with a debit because it's an asset, right? Costs typically include the purchase price, the cash purchase price of the land. Closing costs, such as title and attorney's fees associated with the acquisition. Real estate broker's commission, again associated with the acquisition. And any accrued property taxes and other liens on land assumed by the purchaser, again, at acquisition. Here's an illustration. Hayes Company acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is removed at a net cost of $6,000. Additional expenditures are attorney's fees and real estate broker's commission. Determine the amount to be reported as the cost of the land. Remember, getting it ready for its intended purpose. There's the cash price of $100,000 plus the net removal costs, attorney's fees, again, associated with acquisition, and real estate broker's commission, again, associated with acquisition. Cost of the land is $115,000. The removal of the warehouse is not a current expense. The attorney's fees is not an expense. The real estate broker's commission is not an expense. It's part of the asset of land. Cost of land improvements includes all expenditures necessary to make the improvements ready for their intended use. Limited useful lives. Again, these are improvements expensed by depreciating over the useful life. Examples of these things are paving, a parking lot, fencing around the property, lighting of the property. These are land improvements subject to depreciation. What we're going to find out is land is not subject to depreciation. Cost of buildings includes all costs related directly to purchase or construction. Purchase costs, the purchase price, closing costs associated with acquisition, attorney's fees, title insurance, and real estate brokers commission, very similar to land, right? Remodeling and replacing or repairing the roof, floors, and electrical, wiring, and plumbing. Construction costs, contract price, plus payments for architect fees, building permits, and excavation costs. These are not expenses. These become part of the asset. Equipment costs, example, include all costs incurred in acquiring the equipment and preparing it for use. Costs typically include the cash purchase price, sales tax paid on it, freight charges to bring that piece of equipment to the plant, insurance during the transit paid by the purchaser, expenditures for assembling, installing, and testing. So again, you can see all costs associated with getting that asset ready for its intended use are included in the cost of the equipment, the asset. Those things are not expenses. Example for a piece of equipment. Leonard Company purchases a delivery truck at a cash purchase price of $22,000. Related expenditures, or shall we call them disbursements, because we don't want to consider them expenses, are sales tax, painting and lettering, motor vehicle license, and 3-year accident insurance policy. Compute the cost of the truck, the cash price, the sales tax, getting it ready for its intended use, and the lettering. But you can see that the motor vehicle license will be an expense and the insurance will be an expense. Here's your journal entry. The equipment, right, $23,820, that's the asset. License expense for $80. And prepaid insurance, it's an asset, remember, because this is a 3-year insurance policy. And that needs to be expensed over the 3-year period. Expenditures during the useful life. Ordinary repairs are expenditures to maintain the operating efficiency and productive life of the unit. These are expenses, not assets. Debited to the maintenance and repairs expense account on the income statement. Additions and improvements. These are costs incurred to increase the operating efficiency, productive capacity, or useful life, extend the useful life of the asset. These are assets debited to the related plant asset account. To buy or lease. Should we lease something versus buying it? A lease is a contractual agreement in which the owner of an asset, the lessor, allows another party, the lessee, to use the asset for a period of time at an agreed price. Advantages of leasing: reduced risk of obsolescence, because the lessor bears that burden, little or no down payment, and shared tax advantages. Drummond Corp purchases a delivery truck and incurs the costs below. Explain how the company should account for each of these costs. Invoice cost of the truck, It's going to be cost of truck, the asset. Sales tax, again, getting it ready for its intended use, part of the asset. Delivery costs, getting it, again, ready for its intended use. It's going to be part of the asset. $200 for painting and lettering, again, getting that truck ready for its intended use. $600 for an annual insurance policy. That will eventually be an expense for the year, not part of the asset. $80 for motor vehicle license, again, part of it's an expense. So let's talk about depreciation. So we've previously in Learning Objective 1 discussed the cost of the asset. Now, a capital asset, by definition, is something that provides economic benefit to the company over a long period of time, over its useful life. And the useful life is determined based upon the asset. You can well imagine that a truck probably has a useful life of 5 to 7 years versus a building that may have a useful life anywhere between 25 and 50 years. The useful life depends on the asset. The cost of that asset needs to be spread, or shall I say allocated, over the asset's useful life. Hence, depreciation is how we do that. The process of allocating to expense the cost of a plant asset over its useful life in a rational and systematic manner. Process of allocation, not asset valuation. Applies to land improvements, buildings, and equipment, but not land. Land does not decrease in value. Allocated and depreciable because the revenue producing ability of the asset will decline over the asset's useful life. I've said depreciation is the allocation of cost of an asset over its useful life. Allocation. Depreciation expense is reported on the income statement, and we have this account called accumulated depreciation reported on the balance sheet. Accumulated depreciation is an contra asset account. It's a permanent account, which means that it doesn't get closed out at the end of the accounting period. Accumulated depreciation is the accumulated or total depreciation on that asset since its acquisition. Factors in computing depreciation. Cost, what did we pay for? And we just went through that analysis. What's the useful life? This is an estimate of the expected life based on need for repair, service life, vulnerability to obsolescence. How long will that truck last? We estimate 5 to 7 years. Salvage value, even more of an estimate of the asset's value at the end of its useful life. So we may buy a truck, and that truck may cost $100,000. What is it going to be worth at the end of its useful life? Again, it's an estimate. Selecting a method. So we're going to see 3 methods here. And we're going to realize that one of them is the predominant method. Management selects the method it believes best measures an asset's contribution to revenue over its useful life. We're going to look at 3 methods: straight line method, declining balance method, and units of activity method. And you can clearly see from the pie chart there, depreciation expense is most usually calculated using the straight line method. It's the easiest to apply, but it's also the most popular. Here's an illustration. Bill's Pizza purchased a small delivery truck on January 1, 2022. The cost, $13,000. Estimated salvage value at the end of its useful life, $1,000. Estimated life in years, 5 years. Estimated life in miles, 100,000. Let's calculate depreciation using 3 methods. First one is the straight line method, which is basically original cost minus salvage value divided by useful life. And you can see the cost is $13,000. Salvage value is $1,000. The numerator, therefore, is $12,000 divided by 5 years. The annual depreciation expense is $2,400. You can see the calculation of depreciation over the 5 years, 22, 23, 24, 25, 26. 20% a year, right? 5 years, 100 divided by 5 is 20%, $2,400 a year. And most importantly, you can see that book value is original cost minus accumulated depreciation. So in the first year, the original cost was $12,000. The depreciation that first year is $2,400. The book value is $10,600. And you can see, more importantly, that we depreciate that asset down to the point of its salvage value. So at the end of 5 years, the net book value, original cost minus accumulated depreciation, is exactly equal to the salvage value of $1,000. Here's the journal entry to record depreciation expense. And I would say this is an adjusting journal entry because it doesn't represent a transaction. It's an adjusting journal entry. And remember the definition of an adjusting journal entry. It affects an income statement account and a balance sheet account, but never cash. In this example here, depreciation expense is our income statement account, and accumulated depreciation is our balance sheet account. It happens to be a contra asset account. That's the straight line method. The method, the formula, original cost minus salvage value divided by useful life equals your depreciation expense number. Here's another example. January 1, 2022, Iron Mountain Ski Corporation purchased a new snow grooming machine, $50,000. The machine is estimated to have a 10-year useful life with a $2,000 salvage. What is the journal entry that Iron Mountain Ski Corporation makes at the end of the year, right? They acquired it on January 1. They're making an entry at the end of the year, so they got 1 full year's worth of depreciation using the straight line method. Original cost minus salvage value divided by useful life. You can see $4,800 a year. Here's our second method, declining balance method. It's an accelerated method, which means we take more depreciation expense in the first few years than we do at the end. The idea is that you use that new asset more during the initial years. Decreasing annual depreciation expense over the asset's useful life. Double declining balance rate is double the straight line rate. Rate is applied to the book value. Again, what's book value? Original cost minus accumulated depreciation. So here's our computation. The book value at the very beginning is its original cost, $13,000. The depreciation rate is declining balance, double declining balance, twice the straight line rate. The straight line rate was 100% divided by 5 years is 20%. Double that is 40%. 13,000 times 40%. The first year's depreciation expense is $5,200. The second year, you take the book value of $13,000 minus the first year's depreciation of $5,200. Book value is $7,800. Again, times the 40%. Annual depreciation is $3,120. What's important to realize at the end of in the last year, in the 5th year, you can only take depreciation expense up to the salvage value. So you can see that first year is $5,200. The last year is $685. It's an accelerated method. Units of activity method. Companies estimate total units of activity to calculate depreciation cost per unit. Expense varies based on the units of activity. In other words, how it's used. In our example, we're using a truck. They're going to measure activity with the number of miles. The idea being that that vehicle is used up based upon the mileage, how many miles it has. In our example, they estimated that this vehicle would have 100,000 miles as useful life. So the depreciable cost, right, original cost minus salvage value is $12,000 divided by the 100,000 miles. The depreciation cost per unit, per mile, is 12 cents. First year, so they have to tell you a couple of things. They have to tell you the total estimated activity, and then they need to tell you the estimated activity per year. So in the first year, they actually used up 15,000 miles at 12 cents. Depreciation expense is $1,800. Here's a chart that shows depreciation based upon the miles used. And again, you're going to depreciate this down to the salvage value. Units of activity, mileage, times the rate per mile, 12 cents. Here's a comparison of the three methods: straight line, declining balance, and units of activity. You can see the straight line reveals an equal depreciation amount per year. The declining balance is an accelerated method, takes all the depreciation up in the first couple of years, a majority of it, and then units of activity follows whatever level of activity you have. It ultimately results in the allocation of the cost of that asset over its useful life, 5-year period. Depreciation and income taxes. IRS does not require taxpayers to use the same depreciation method on the tax return that is used in preparing financial statements. IRS requires either the straight line method or a Internal Revenue Code prescribed method called MAKERS, Modified Accelerated Cost Recovery System. It is defined by the IRS code. The point being here that there is a difference between book and tax. Book depreciation is financial accounting depreciation, which we just looked at. Tax depreciation is prescribed by the IRS, and there is always a difference between the two. In other words, two sets of books, two sets of calculations. Here is a footnote example. You can read that. It's for Southwest Airlines. Revising periodic depreciation. Remember, depreciation is an expense. Depreciation is an estimate. There's going to be times we need to revise that estimate. Revising periodic depreciation accounted for in period of change and future periods. We don't go back. It's just for this year and going forward. Considered to be a change in estimate, not handled retrospectively. In other words, you don't go back. It's only this year and going forward. It's not considered an error. It's simply a change in estimate. We've got new information. Maybe the asset's going to last longer. Maybe the asset's not going to last as long as we thought it was. And we need to change the calculation. Here's an example. Bill Pizzas decides at the end of 2025 to extend the estimated useful life of the truck. They think it's going to last longer. A total life of 6 years. And increase its salvage value to $2,200. The company has used a straight line method to date. Depreciation per year was $2,400. Accumulated depreciation after 3 years is $7,200, and the book value is $5,800. The new annual depreciation is $1,200. Here's the calculation. Book value at the time of change, $5,800. Less the new salvage, right? Cost less salvage divided by useful life. The book value at the date of change is $5,800. Original cost minus accumulated depreciation to date, $5,800. And you can see that right here, right? It says the original cost, well, we knew the original cost was $13,000, and it said accumulated depreciation after 3 years was $7,200, hence book value $5,800. The new salvage value $2,200, depreciable cost $3,600. The remaining useful life, the number of years left, 3 years. The new depreciation expense is $1,200, not $2,400. Impairments is a permanent, not a temporary, a permanent decline in the fair value of an asset. The asset is written down to its new fair value during the year in which the decline in value occurs. Avoids overstating the asset in the accounting records. If there's a permanent impairment, you need to write it down in the year it happens. Here's another example of a revised depreciation. Chambers Corporation purchased a piece of equipment for $36,000. It estimated a 6-year life and $6,000 salvage value. Thus, straight-line depreciation was $5,000 per year. Original cost minus salvage divided by useful life. At the end of year 3, before the depreciation adjustment, it estimated the new total life to be 10 years and the new salvage value to be $2,000. Compute the revised depreciation. So the original depreciation expense was $5,000 a year. The accumulated depreciation after 2 years was $10,000. The book value of that asset is now $26,000. Original cost minus accumulated depreciation. Book value, $26,000. The new salvage value, right? Book value minus salvage value divided by the remaining years. Depreciable cost is now $24,000. The remaining useful life is 8 years. The annual depreciation is $3,000 per year for this year and going forward. So we talked about depreciation. We talked about revised depreciation. Now let's talk about what if we sell an asset. Okay, we initially bought it, we depreciate it, but now we want to get rid of it. We don't want to use it anymore. We want to replace it. Disposal of plant assets. There's 3 ways companies dispose of an asset. They sell it. A sale transaction is what? They give up the asset, they receive cash. The second one, they just scrap it. It's worth nothing, get rid of it. Third one, we have an exchange, truck for truck. That gets a little complicated. Accounting for disposals, record depreciation up to the date of sale. So you come up with book value at the date of sale. Eliminate the asset. So there's 2 pieces to that asset, the original cost and the accumulated depreciation on that asset. Determining gain or loss. Compare the book value of the asset, book value, right? Original cost minus accumulated depreciation with the proceeds received. Book value is what we give up. Cash is what we receive. If the proceeds exceed the book value, we have a gain. If the proceeds are less than the book value, there's a loss. Example. On July 1, 2022, right? Exactly 6 months into the year. January 1 through June 30th is 6 months. July 1 is essentially the 6-month period, right? Half a year. Wright Company sells office furniture for $16,000. That's what they receive. They sell the furniture, they give up the old asset, they receive cash. The office furniture originally cost $60,000, and as of January 1, 2022, had accumulated depreciation of $41,000. Depreciation for the first 6 months is $8,000. Wright records depreciation and updates the accumulated depreciation to July 1, right? Half a year's depreciation. Got to bring depreciation expense, the accumulated adjustment, accumulated depreciation account up to date. The original cost of the furniture minus the accumulated depreciation, the $41,000 up to January 1, 2022, the additional $8,000 through June 30th, 2022, another $8,000, accumulated depreciation $49,000. The book value, original cost, minus accumulated depreciation, $11,000. They sold it for $16,000. They gave up something with a book value of 11. They received cash of 16. They have a gain. Here's the journal entry. So there is essentially 4 things you need to do. Record the cash, remove the old accumulated depreciation, remove the asset, and then record gain or loss. Receiving the cash is the easy piece. Cash goes up, receive cash, debit cash for $16,000. Debit accumulated depreciation. Accumulated depreciation has a normal credit balance. To get rid of it, you need to debit it. That's what they did here. You need to remove the old asset. The asset has a normal debit balance. To decrease an asset, you need to credit it for its original cost. To make the entry balance, to agree with the gain calculation above, your debits have to equal your credits, gain on sale. It's like a revenue account. You increase a revenue account with a credit. Accounting for plant illustration. Assume that instead of selling the office furniture for $16,000, Wright sells it for $9,000. Again, it's a comparison between the book value given up and the cash received. Book value given up was $11,000. They received $9,000. They have a loss. Very similar journal entry. Record the cash. Remove the accumulated depreciation. Remove the asset. Record gain or loss. There's your journal entry. Retirement of an asset. No cash received here. They just get rid of it. Decrease accumulated depreciation with a debit for the full amount of depreciation taken over its useful life. Decrease the asset account with a credit for the original cost of the asset. You still got to remove the asset. It's just no what? No cash. Here's an example. Overland Trucking has an old truck that costs $30,000. It has accumulated depreciation of $16,000. Assume two different situations. One, the company sells the old truck for $17,000 cash. So here's the journal entry scenario one. They received the cash, $17,000. Remove the old accumulated depreciation of 16, remove the asset of 30. In order to make the journal entry balance, in order for debits equal credits, you need a credit, gain on sale of plant assets. Scenario two, truck is worthless. So they retire it. The key here, remove the accumulated depreciation with a debit, remove the asset with a credit. Your debits have to equal your credits. You need a debit. The debit is a loss. The debit's like an expense. You increase an expense with a debit. Loss on disposal. So those were tangible assets, things you could put your hands on. But there is another group of assets called intangible assets. What's going on there? Intangible assets are rights, privileges, and competitive advantages that result from ownership of long-lived assets that do not possess physical substance. They may have a limited or an indefinite life. Common examples are patents, copyrights, franchises, trademarks, trade names, and goodwill, all intangible assets that have value. Limited life intangibles. We're going to amortize them to expense. If they have a useful life, then we can allocate the cost of that intangible asset over its useful life. Instead of calling it depreciation expense, we call it amortization expense. And instead of accumulated depreciation, we call it accumulated amortization. What about indefinite life intangibles? No foreseeable limit on time asset is expected to provide. We have no estimated life. We can't amortize it. Cost of patents. What is a patent? An exclusive right to manufacture, sell, or otherwise control an invention for a period of 20 years from the date of grant. Capitalize the cost of purchasing a patent and amortize it over its 20-year useful life, 20-year life, or its useful life, whichever is shorter. Expense any R&D, research and development cost, in developing a patent. Legal fees incurred successfully defending a patent are capitalized to the patent account. Let's look at an example. National Lab purchases a patent at a cost of $60,000 on June 30th. National estimates the useful life to be 8 years. Prepare the journal entry to record the amortization for the 6-month period ended December 31st, right? They purchased it on June 30th. At the end of the year, you need an adjusting journal entry to amortize that asset. The annual expense, is $7,500, right? $60,000 divided by 8 years. National records $3,750, which is a half a year. Debit the expense, amortization expense, credit the asset, patents. You could credit the asset patents or credit accumulated amortization. Either one's fine. Research and development costs. These are expenditures that may lead to a patent, copyright, new process, new products. All R&D costs are usually expensed when incurred. Why? Because you're not guaranteed that you're creating an asset. It's research and development. Copyrights gives the owner exclusive right to reproduce and sell an artistic or published work, granted for a life of creator plus 70 years. Capitalized costs of acquiring and defending, amortized to expense over the useful life. What's the useful life? Life of the creator plus 70 years. What are trademarks? Word, phrase, jingle, or symbol that distinguishes or identifies a particular enterprise or product. You know what some of these trade names and trademarks are. Monopoly, Kleenex, Coca-Cola. Legal protection for an indefinite number of 20-year renewable periods. Capitalize the acquisition costs, not the development cost, the acquisition cost. No amortization. Why? Because you really don't have a definite useful life. Franchises, a contractual arrangement between a franchisor and a franchisee. Toyota, Shell, Subway, Marriott are franchises. So you have a company like Marriott Hotel. So they have a name, they have a brand, and what happens, somebody may want to open up a particular hotel. You own the hotel, not Marriott. They get a franchise. Franchise or license with a limited life should be amortized to expense over the life of a franchise. So it has a definite useful life. Because it has a definite useful life, it can be amortized. Franchise with an indefinite life should be carried at cost and not amortized. So the key here is what? A definite useful life. Goodwill includes exceptional management, desirable location, good customer relations, skilled employees, high quality products, etc. Only recorded when an entire business is purchased. Purchase goodwill only. Goodwill is recorded as the excess of the purchase price over the fair market value of identifiable net assets. So you buy something, you buy a company, you buy $1 million, you pay $1 million for that company. If you determine that the fair value of the identifiable net assets are only $700,000, you've got $300,000 of goodwill. You paid extra for that company because it has what? Exceptional management, a desirable location, good customer relations, skilled employees, high quality products. You paid more for that company than the underlying assets. That's called goodwill. Internally created goodwill should not be capitalized. It has to be purchased goodwill. Let's look at an example. Match the term most directly associated with each statement. Number one, the allocation to expense of the cost of an intangible asset over its asset's useful life. Of course, amortization. Rights, privileges, and competitive advantages that result from the ownership of long-lived assets that do not possess physical substance, right? Intangible assets. An exclusive right granted by the federal government to reproduce and sell an artistic or published work. Copyright. And a right to sell certain products or services or to use certain trademarks or trade names within a designated geographic area. Franchise. And number five, costs incurred by a company that often lead to patents or new products. These costs must be expensed as incurred research and development because it doesn't necessarily result. in a patent or new product. Discuss how long-lived assets are reported on the balance sheet and income statement and how they're analyzed. Here's a balance sheet for Artex. And again, you're looking at the asset section. Assets are listed in the order of liquidity. Starts with cash, accounts receivable, and inventory, total current assets. Then you get to your property, plant, and equipment. And you see there's a breakdown between land and buildings. Land, as you know, is an asset used in production to help generate money, but it's not subject to depreciation. You have buildings and then accumulated depreciation associated with the buildings. And then you have equipment and you have accumulated depreciation associated with that equipment. And then total property, plant, and equipment, which is net of what? Net of accumulated depreciation. And you can see this company has some intangible assets that are reported net of accumulated amortization, if there is amortization. So here's the first calculation, return on assets, which is net income divided by average total assets. So the net income number has to be provided to you, and then what? At average total assets, beginning balance plus ending balance divided by 2. So you can see here return on assets for JetBlue Airlines in 2017 was 12%, up from 2016 at 8.4%. But you can see Southwest Airlines has got a much better return on assets than the JetBlue. Asset turnover. Again, familiar calculation, right? Asset turnover, we talked about accounts receivable turnover, we talked about inventory turnover, now we're talking about asset turnover. Net sales divided by average total assets. And what they're saying here for JetBlue, it turns over 0.73 times, in 2016, 0.74 times. And again, what Southwest is still doing better. Profit margin revisited. Don't worry about this. Don't worry about that. Here's an example of an asset turnover. The company reported net income of $180,000, net sales $420,000, and had total assets of $460,000 at the beginning of the year, $540,000 at the end of the year. So what is the asset turnover? Net sales divided by average total assets. Asset turnover 0.84 times. And we're not going to cover that. We're not going to cover that. So that is the material for Chapter 9. Thank you.